Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello dear students, CA final September 25 AFM exam is just a couple of days away. In order to help you guys for the exam, I want you to spend probably around an hour going through few important questions that are there in September 25 RTP. Slightly different, slightly weird, slightly novel or new kind of questions. So these questions I have listed out below. There are 4 or 5 questions only. 2 of them are MCQs and about 2 or 3 are non-MCQ questions, which are basically where you have to solve. Okay, so let us go and look at all these questions, and my request is just have a look at it before you go to the exam. Okay, chaliye, all the very best. Please do like, share, subscribe to our channel and do watch this video fully so that you are prepared for your upcoming exam. Chalo, let's look at the first question. Let's look at it. The first question is on advanced capital budgeting. Now this is where they have given separate revenue, inflation and cost inflation, and then they've asked a bunch of MCQ questions based on that. So there's a project, the project has certain revenues, certain costs, there's an investment, there's no salvage value, some depreciation is there, there's a tax rate, and including inflation premium, something is the cost of capital. You are now supposed to find out a bunch of points. Now this question is straight from study material and what we have solved in class also, which is why I'm not actually going to solve it. This is P600 plus the question number 2, okay, and ICAI SM. Okay, this is very clearly there in our material and what I've solved in classes as well as what is there in ICA study material. So there is no great something new that has come up. Okay, so I'm not going to spend time on this. There are questions on which I'm going to spend time. Please, wait. Second question is one on which I'm actually going to spend time. This is on financial policy and corporate strategy. Now, if you guys recollect, they have introduced this new concept of external funding requirement. It was made applicable from May 25. On that, they gave a question also in May 25 where, how to compute EFR and all of that. Same thing or probably related to that, they have actually asked a question. And again, this is also an MCQ question, but unfortunately what they have done is, I didn't like the quality of one of the questions, okay, because it was not given properly. But anyway, I'll read out what the question is and then we'll go through it. It's a fairly simple one, you'll see as we proceed. In a recent board meeting of N Limited, following financials of N Limited for the 31st March 25 were presented. Equity capital, so this is already year that is already over. For that they've given data. Equity 480,000. Okay, so if you take it is probably 480 million or 48 crores, but they've said 48 here, rupees 1000 is there, no, so you have to be careful with that. 10% bonds 92,000, sundry creditors 66,000, bills payable 88,000, other current liabilities 44,000, total liabilities 7.7 lakh. Okay, they've also given the income statement along with the balance sheet. Sales 11.77 lakhs, material 4.18, wages 2.64, factory overheads 129,800, your gross profit 365,200, S&D 1,10,000, admin cost 1,22,000. So you basically your EBIT is 1,32,400. Then interest charges 9,200 on these on this 10% bonds of 92,000, 9,200. EBT 1,23,200. Taxes at 50% is something. Net profit is something. Now what is it that they're getting at? During the board meeting, Director A said that the company can maintain a certain growth even though the net profit margin remains constant and asset increase proportionately to sales and it distributes 30% of its net profits. To maintain this growth rate, it will not require any external funds. Director B proposed that just by maintaining a target capital structure and without issuing additional equity and maintaining target dividend payout ratio as proposed by Director A, more growth can be achieved. Then Director C said, even though he agreed with views of A and B, but is of the view that in the coming years it is expected that sales is likely to rise by 15% the coming year, that is next year, 25-26. Hence it is required we can go for issue of equity shares, bonds or debentures to achieve the same growth in sales. Now first question. From the following information or from the information given above, choose the correct answer to the following questions. Okay, first question, Director A is talking about what? So what is it Director A is talking about? Before you actually go to what Director A is talking about, please have a look at what is question number 1, question number 2 and question number 3. All 3 questions, if you recollect, we said first go through the questions, then the paragraph or question, the entire case. But here, whatever I say, I actually didn't follow. I first read the case and then came to questions. We have to be very careful. So they're asking Director A is talking about what, Director B is talking about what, Director C is talking about what. And then the fourth question is, if you go by proposal of Director C. Okay, so this Director C, fourth question is independent. Now, what are A, B and C talking about? See, if you recollect the concepts of sustainable growth rate, external funding requirement, all three of them are talking about those. Okay. Now, Director C is very clearly saying that in the next year there is likely to be a 15% increase in revenue, so we should go for issue of equity shares. What is this clearly? Equity shares or even bonds and debentures to achieve the same growth. So, what is Director C talking about? He is very clearly talking about external funding requirement or financing requirement. So, Director C is definitely answer external funding requirement, not external growth rate. There is no concept called external growth rate. Okay. Now, Director A and Director B. What are Director A and Director B talking about? Director A spoke about certain things and Director B said, that is there and something else also is there. Director A said, company can maintain certain growth even though net profit margin remains constant and assets increase proportionate to sale, and it distributes 30% of its net profit. To maintain this growth rate, it will not require any external funds. What is he talking about? He is talking about sustainable growth rate. But has he covered all aspects? No. Director B is saying, Director B proposed that just by maintaining a target capital structure and without issuing additional equity and maintaining target dividend payout ratio as proposed by Director A, more growth can be achieved. So, if you look at Director A and Director B, both of them combined, because what does sustainable growth rate say? It says you are not raising any fresh debt or equity, then you are maintaining a dividend payout structure or payout ratio, then you have something called a sustainable growth rate, right? So, is A sustainable growth rate or B sustainable growth rate? See, C we have anyway clearly defined external funding requirement. So, this is done. A or B? What are the options they have given you? See, internal growth rate, sustainable growth rate, external funding requirement, external growth rate. But there is nothing called external growth rate. Internal growth rate also I have not heard of. Okay. So, internal growth rate also I have not heard of. So, what do you answer in this situation? See, very clearly B or the question number 2, right, is talking about sustainable growth rate because he has added to the points of whatever Director A has said. Okay. Now, is Director A talking about sustainable, internal, external growth rate, or what is he talking about? See, Director A is only talking about you can maintain certain growth even though margin remains constant, asset increases proportionately and it distributes 30% of its profits to maintain its growth, it will not require any external funds. So, is he talking about sustainable growth rate? Yes. Is he talking about internal fund generation? Yes, he is talking about that also. Is he talking about external funding? No, he is saying no external funding. Is he talking about external growth rate? No, he is not talking about that. So, actually, what they have given answer for question number 1, they have given it as internal growth rate. By the way, internal growth rate is not something that we have heard of this term anywhere in our material so far. But they've given something called internal growth rate. See, question number 1 and 2 look very similar. Ideally, this should be sustainable growth rate because you have covered some points of it, and Director B also covered balance points of it. If you are saying Director B is covered balance point and only he can be treated as if having covered the entire concept of sustainable growth rate, then what did he do? Half of sustainable growth rate. If it is half of a sustainable growth rate, is it called internal growth rate? I don't know. I have never heard of that term. Is it internal fund generation? Yes, because you are not going to raise any funds. You are going to use the same net profit for plowing it back into the company and you are going to generate growth. So, ideally, it should be internal fund generation. This is my opinion. Okay, but they have given answer as internal growth rate, which we have not heard as a concept anywhere in our material so far. So, ICA is ICA. Despite me giving thumbs up for the quality of the RTP that has gone up, these are the kind of small things that they have made unnecessarily created confusion in the minds of the students. Okay, now these 2 are good, these 3 are over. Now come to the 4th question. Okay, question number 4. Now this is an interesting one. If we go by the proposal of Director C, then approximately dash funds shall be raised in form of equity or debt, assuming that dividend as proposed by the Director A is paid out and assets and current liabilities are increased in the same proportion as increase in sales. So, now first what is increase in sales? I think we read somewhere some 15% or something. Sales is 15% and payout ratio is 30%. So, sales is 15%, then dividend is paid out, this is 30%, then assets and current liabilities are increased in same proportion as sales. And they also said one more very important thing, which is here, maintaining target dividend ratio. Here you see what Director A said, net profit margin remains constant. So you have to consider all the aspects what they've mentioned. And what is net profit margin here? If you come and see this divided by this, okay, which is 61,600 divided by 1177,000, you get 5.2336%. Okay, this margin is going to remain constant on what? On 1.15 into 11,77,000 thousands. Okay, 11,77,000 into 1.15 into 5.2336%. You will get 70839, or you can take 70840, 70840. So profit is increasing and your assets and liabilities will also increase. Now please note, this total is 770. These three add up to some number. If you add these two, you get what? 5,72,000. So balancing figure here will be 1,98,000. Correct, no? These three are 1,98,000, this is 5,72,000. Now equity and bonds, we need to find out how much they should increase. Okay, out of that increase, some amount is going to come from your profit, right? Whatever is retained profit. Now, what is the total increase in assets and liabilities? See what they've said. They said assets and current liabilities, everything will go up by the same percentage. So if you see here, the difference between these two, 770 minus 198 will be same 5,72,000. So this 5,72,000, whatever is there, that will increase by 15%. Net number, net assets, that is assets minus liabilities, will increase by 15%. That 15%, whatever increase is going to happen, this minus this, same thing has to happen here. Correct? No. So if you move this 198 here, it will become 572 on the asset side. Same way, liability side will also be 572. If this is going to go by 15%, your equity and bonds also have to go up by 15%. How much will they have to go up to? How much of that is retained earnings? How much of that is debt? We will come to it. But this has to go up. And one more very, very critical point. If you are going to increase your net profit by 5.2336%, whatever this is number is here, right? 61,600 into 1.15, 70840, correct? You have increased it to 70840. You can directly apply the 15% growth rate on net profit because margin is going to remain the same, okay? The key point here is interest also you are increasing. See, if you are going to increase sales, going to increase expenses, going to increase all items by 15%, which is why your PAT is also going up by 15%. Does that mean that your interest is also going to go up by 15%? If interest is going to go up by 15%, what does it mean? If the interest cost of these bonds is same 10%, assume, okay, then your debt has also gone up by 15%. So your debt of 92,000 will increase by 15%, which is 92,000 into 0.15, which is 13,800. So 13,800 is actually going to be increase in debt, which is why your cost of debt is also increasing by 15% and all incomes have also increased by 15%, which is why your profit is also increased by 15%. Very important point, please note. Now coming back, what are we supposed to answer? We are supposed to answer this number here. If you are supposed to fill this number, what is that number? How much of the fund shall be raised in the form of equity or debt? So this 70840 is the net profit. Out of this, 30% retained. Retained is 70%. Paid out is 30%. So 70% of 70840 into 0.7 is 49588, and if you subtract, you will get 21252. So this is going out of the system. This is what is retained in the system. Now this is retained in the system. How much is the total increase that we require from all the equity and debt holders, or rather how much is the total financing that we require? We require 15% of 5,72,000, which is what? 5,72,000 into 15%, which is 85,800. What I just discussed, that is, you take net assets, move these current liabilities to the asset side, and you get net assets of 572, because 770 minus 1, this is 198 only, right? Yeah, 198. You get 572. So that 572, if it is going to increase by 15%, why? Because they said that the assets and current liabilities are going to go up by the same percentage growth as the sales. So this is going to go up by 15. Then your equity and debt will also go up by 15. What is the total increase? 85,800. But out of this 85,800, how much is the internal money that is generated? Internal money that is generated is 49,588. So internal generation total increase is how much? 85,800. From that, you subtract internal generation, 85,800 minus 49,588, which will be 36,212. This 36,212 already assumes what? That your debt has increased by 13,800. Why debt has increased by 13,800? Because your interest cost has already gone up. Assuming same interest percentage of 10%, your overall outstanding loan should increase. So your debt has gone up by 13,800 out of total increase of 36,212. 36,212 is the total external funding requirement, out of which 13,800 is debt and balance should be equity. Balance should be equity, which is minus 13,800, which is 22,412. 22,412. Okay, now what is the question that they have asked? They have asked, fill this number. If you go by so and so, how much shall be raised in the form of equity or debt? Both together. Assuming dividend so and so is paid out and assets are increasing in same proportion, 36,212. That is what is the number we got, no? Where is it? Yes, 36,212. Same number we got. So answer here is 36,212. So answer here is 36,212. Okay, so please keep this in mind. You have to be very careful when you solve a problem like this. On the face of it, it may look complex, but actually it is not. It's actually fairly simple only. So friends, let us look at this next question. This is a slight variation. We have not solved a question like this. This is actually a September 25 RTP question. The reason why we have not solved a question like this is, so far we have solved questions which are related to your conversion of equity share. Here we are talking about a preference share. There is a slight twist, and there are other things also which are fairly simple, nothing complex, but it is a new variety which you have not solved. Okay, you have to have your, you have to be at very sharp. You cannot say I forgot something and all that. Okay, you have to remember the stuff that you studied in inter or basic concepts, nothing fancy. XYZ Limited has current earnings of 3 per share with 5 lakh shares outstanding. Okay. The company plans to issue 40,000 7% convertible preference shares of rupees 50 each at par. The preference shares are convertible into 2 shares for each preference share held. The equity share is a current market price of 21. Then there are 4 questions. I think there's a typo here. Let us ignore this typo. First question is, what is preference shares conversion value? What is conversion premium? Assuming that the total earnings remain the same, calculate the effect of issue of basic earnings per share before and after conversion. If profits after tax increase by 1 million, what will be the basic EPS before and on a fully diluted basis? So let us reread the question or understand the question better. It has some current earnings with some share count. It plans to issue some preference shares. The shares are convertible into equity. Current market price of equity is also something. What is preference shares conversion value? What is conversion value? We remember the formula. Same thing what we did for debenture to equity conversion, same logic. What is conversion premium? How much is the conversion premium? Okay. Assuming that the earnings remain the same, calculate the effect of basic EPS. That is, if the earnings are going to remain the same, if before conversion, what is EPS? After conversion, what is EPS? Very, very simple. And if profits increase, what is before conversion, what is EPS, after conversion, what is EPS? Very simple. Okay, it appears complex, but actually it is not. It is very simple, just like debenture conversion, we have preference share conversion. Okay, so solution. First part. What is the first part of the question? What is preference shares conversion value? So 21 is current market price of equity share. Current market price of equity share is equal to rupees 21. Conversion to equity for 1 preference. Correct, no? That is what they said. Plus to 40,000 7% convertible preference shares of 50 each at par. The preference shares are converted to 2 shares for each preference share held. So conversion value is equal to 21 into 2, that is equal to rupees 42. That's all. There's nothing else. Then conversion premium, that is what they asked, right? Conversion premium. What is the conversion premium? What is conversion premium? Conversion premium can be given in rupee terms and percentage terms also. Current market price of equivalent equity shares or conversion value is 42. Issue price of preference. Is that the issue price or is that paid up value? Convertible shares of rupees 50 at par. Okay, both are same. Is rupees 50. Conversion premium is equal to difference between those two, rupees 8. Conversion premium percentage. Conversion premium percentage 8 upon 42. 8 upon 42. 8 by 42. That is equal to 19.047. So I'll take 0.5%. Okay. Super simple. We are through. Then coming to the next part. What is the next part? What is assuming that the total earnings remains the same? What are the total earnings? We don't know. We'll see here. EPS of 3 and 5 lakh shares, so 15 lakhs remain the same. Calculate effect of calculate the effect on issue of basic earning per share before conversion, after conversion. So PAT is equal to EPS into share count is equal to 3 into 5 lakh is equal to rupees 15 lakhs. Correct? Now, if this is the share count of equity share count. Okay. Now, how many shares, preference shares issued? 40,000 or something, no? Company plans to issue 40,000 7% convertible preference shares. Now, preference shares issued 40,000 at rupees 50 each. Preference share capital is equal to 40,000 into 50, which is 20 lakhs. Correct? What is preference dividend? At 7% of 20 lakhs is 1,40,000. What is, why are we computing this? Because EAESH, what is EAESH? The earnings available to equity shareholders is equal to rupees 15 lakhs minus 1,40,000. See, when the company issued these preference shares, the profit has not gone up, but the share count has increased. Why? Probably the project has just started. The money raised in through preference share issue was probably not deployed. That is why the EPS, that is why the EASH is lower. Right? Otherwise, ideally the profit should also increase, and from that you will pay off the preference dividend. So, which is how much? 13,60,000. What is share count? Share count is 5 lakhs. Equity share counts. Okay, now here equity share count. This is what? Before conversion. 5 lakhs. So EPS is equal to 13.6 lakhs by 5 lakhs. Which will be what? 2 rupee 72 paisa. Now, if conversion happens, PAT is equal to EAESH is equal to 15 lakhs. Why? Because once you convert, there is no preference dividend to be paid, correct? But share count is equal to equity is 5 lakhs plus preference converted to equity is equal to 40,000 into 2. This is 5 lakh plus 80,000, that is 5.8 lakhs. So EPS is equal to 15 lakhs divided by 5.8 lakhs. That is equal to 2.586. Now this is one set. What is the other set? See here we have taken, if you look at the question, assuming that the total earnings remain the same, which is what I was discussing. We are taking a scenario where earnings are not changing, but potentially earnings will change. Why? Because you have raised money, you will not keep that money idle, no, waiting for it to lay eggs. You will deploy it in a project. When you deploy it in a project, you will earn greater profits. What is the increased profit? 1 million. 1 million is 10 lakhs. So, PAT, assuming additional rupees 10 lakhs earnings. PAT is 15 lakhs plus 10 lakhs, this is equal to 25 lakhs. then EASH will still be there, preference dividend. Why? Because they have asked two scenarios in this, before conversion, after conversion. Preference dividend is equal to, we computed preference dividend earlier, no? How much was it? Preference dividend is 1.4 lakhs. So EAESH is 23.6 lakhs. Share count equity is 5 lakhs. So 23 lakhs 60,000 divided by 5 lakhs is EPS is equal to 4.72. This is before conversion. After conversion, PAT is equal to EAESH is equal to 25 lakhs. Why? Because no preference dividend, right? Share count equity 5 lakhs plus preference convert 80k, 5.8 lakhs. EPS is 25 divided by 5.8, 4.310. 4.310. Okay? So it's a fairly simple question. It is just that this is not something that you would have done earlier. Other than that, there is nothing fancy in this. It's something that you'll simply do before after conversion, basic and diluted EPS. That's all. Okay? Now let us move to the next problem. So friends, now let us look at the next question. This is actually from RTP September 25. It's an interesting question, which is why I added this to this, our list of questions. This is actually a correction or rather not a correction, a different way of solving one of the already pre-existing questions, which is what we just now solved. And I wanted to, show you the revised way in which the institute is solving this problem. Obviously, there are certain slight changes in the question, the way the question is structured. If you look at the previous question and this question, you'll understand automatically on your own. So let us go ahead and look at it. I'll reread the entire question and I will highlight the places where there are changes. Okay. Now, Mr. A and HNI invested on 1/4/2014 certain equity shares as below. 1 lakh equity shares of 100 each, which is what, how many zeros? 2 crores. And Y Limited, 50,000 equity shares of 10 each, 1.5 crores. Okay. On September 2014, 10% dividend was paid out by X Limited. And in October 14, 30% dividend was paid out by Y Limited. Okay. Dividend was paid out. Okay, no problem. On 31 March 2015, market quotation showed a value of 220 and 290 per share for X Limited and Y respectively. On 1/4/2015, a technical analyst indicated as follows. The probability of dividends from X and Y for the year ending so and so are given below. So they are given separate probabilities. Okay, this is the first change. The probabilities of market quotations are given below. Again, separate probabilities of each one of them. Then you are required to analyze the average return from the portfolio for the year 31 March 15, analyze the expected average return of the portfolio for 15-16, and advise Mr. A of the comparative risk in the two investments. Comparative risk in the two investments. This is very similar to a illustration in ICAI study material. I think illustration number 32. And is also very similar to the previous illustration, whatever we have solved in P600 plus. I think illustration number 30. Where it is M limited, N limited, 2 lakhs, 1.5 lakhs and all of that. But the key difference, is dividend probabilities in this are again separate or independent for each of them. Whereas if you look at the question in the study material, there is only probability of prices. Okay, this prices of shares, there are separate probabilities and the price probabilities and values are also same. But the dividends, they directly gave as 20% and 35% in the study material question. Whereas in this question, this is a modified question, in RTP September 25, they have made a change. The change is dividend also, there are separate probabilities. Now, what complication does this bring? This creates something called as a possibility of joint probability. Earlier, we had only one of them which probabilities, which is market prices. Now, market price also there is probability, dividends also there is probability. So, the question itself substantially changes. The first part of the question largely remains the same, but subsequent parts there is a difference wherever these probabilities are applied. So, let us see what is the first part of the question. Analyze average return of the portfolio for the year 31/3/15. What is the average return of the portfolio? So, let us look at the solution. Part 1, average return of portfolio. what is average return on the portfolio? Here we have been given, I'll actually open the question here, so it is easy for me to scroll. You guys can see it in your book. What is average return? See, first original investment. What is the investment? X limited and Y limited. Okay. Investment. How much? 2 crores and 1 crore 50 lakhs. Okay. How many shares? Shares 100,000. That is price per share is 200. Here is 50,000. Price per share is 300. Okay. Then on September 25th, this is when was this investment made? This was made on 1/4/2014. 1/4/14. Okay. Then after that, in September, we don't know when, in September. Okay. Dividend, and I also have to write face value. I forgot. Face value per share. They said face value per share for the first one is 100 and the second one is only 10. Why is this relevant? Because when you compute dividend as a percentage, it is as percentage of face value, unless it is given as dividend yield, in which case it is market value. When they say dividend percentage of the face value of the dividend. In September, 10% dividend. Dividend September 14, 10%, which is DPS rupees, 10% of 100 is 10. Then in October, this dividend was for the second company was 30%. 30% of 10 is 3. Okay, this is dividend per share. Amount received is how much? You multiply this 10 and 3 with number of shares. Correct? So 10 into 1 lakh is 10 lakhs. Then 3 into 50,000, 1,50,000. Okay, amount received as dividend. Then paid out by Y Limited. On 31st March, market quotations. Market price 31,315, 220 and 290. Okay. Then after this, what is the next part? What is the first part? Analyze the average return of the portfolio for the year ended so and so. So return. What is return? Closing minus opening plus dividend divided by opening. Okay, this is return percentage. Correct? So what you will get is return for this is closing is 220 minus opening. What is opening value? We made investment at 200 minus 200 plus dividend. What was the dividend per share? We already found out 10 divided by 200. And this one is 290 minus 300 plus 3 by 300. So you will get what percentage? 220 minus 200 is 20, 20 plus 1 30, 30 by 200. 15%, and the other one is 290 minus 300 is minus 10, minus 10 plus 3 is minus 7. So minus 7 divided by 300 is equal to minus 2.3%. Now what is the average return? Average return is equal to 15% into what is the total weight of the portfolio? 2 crores and 1.5 crore, right, out of 3.5. So into 2 by 3.5 plus minus 2.33% into 3 by 3.5 into 1.5 by 3.5, my bad, into 1.5 by 3.5. Why did I get 1.5? 1.5 crores, no, out of the total portfolio, 1.5 crores is invested here. So the weighted average return of the portfolio is basically the, what is the average return of the portfolio? So taking the weights as the amount invested in the portfolio. That is 15 into 2 by 3.5 is equal to 8.57%. Plus 2.33333 into 1.5 divided by 3.5 is equal to 1. So minus 1%. So that will be 7.57%. So average return is this. Average return is this. Now this is the easier part. In this there is no change. Okay, change comes now. What is the second part of the question? Second part of the question is analyze the expected average return for the year 15-16. So next year, what is the expected return? Expected average return for 2015 and 16. Now in this there are joint probabilities. What are the joint probabilities? Joint probabilities are this also changes, this also changes, that is parallelly there are two changes. For X there are 3 dividends. In each dividend the share price can be different. So totally there are 9 possibilities for X alone. Same way for Y also there are 9 possibilities. So both cases there will be 9 possibilities. So that is what you have to work on. That is what is the precise point which you have to basically get clear in this particular question. That is the primary change. So first look at X Limited. In case of X Limited, what are the 3 possibilities of dividend? They are given dividend as 10% and which is basically 10 rupees. In case of X it is 10 rupees, whereas in Y in case of 15% is 1.5 because the face value here is 10 and the face value here is 100. Okay, so we'll directly take from that and then take the possibilities. So X dividend 10, 10, 10, 10, 15, 15, 15, then 20, 20, 20. Okay, the probability of this is dividend probability is 0.2, 0.2, 0.2, 0.3, 0.3, 0.3, then 0.5, 0.5, 0.5, and what is the price? Closing price. Okay, closing price, what is the closing price? Closing price again has probabilities, which is probability closing price. Probability was 0.2, 0.5, 0.3, which is 220, 250, 280. Same way 0.2, 0.5, 0.3, 220, 250, 280. 0.2, 0.5, 0.3, 220, 250, 280. Now you have these probabilities. Now what is this whole story about joint probability? Basically you multiply these both. Okay, so you get 0.04, 0.1, 0.04, 0.1, 0.06, 0.06, 0.15, 0.09, then 0.1, 0.25, 0.15. Okay, this is joint probability. Now in this, what is the return? See, for each one you have to compute return separately. Each one you have to compute return separately. How will you compute the return? See, return may you have 2 aspects. One is obviously the dividend. So dividend and price. Right. What is the dividend thing? We already have dividend here. What is the price? So I'll do, instead of dividend, because we already have, I'll take combined return. Okay. Price and total. What was the opening price? We took the opening price as previous closing price. Market price here is 220, right? So 220 is the closing price. So here, what could be the potential closing price? 220. So the price return is 0. Why? Closing price here possibility is 220. Opening price, that is previous year's closing price, also 220. So the gain on price account is 0, whereas the dividend gain is 10. Same way here, this is 30, total is 40. How did I get 40? I am adding this 10 to this 30. Okay, then I get 60 plus 10, 70. Okay, then 0, 30, 60, 15, 45, 75. How am I getting this? I am adding 15 as a dividend. Then 0, 30, 60 and 20, 50 and 80. How did I get? 20 plus 60 is basically your 80. So you are adding the dividend in the year plus the price return in the year. Now if you do all of this, you got total return here. Now this is total return. Okay, absolute value. This is again still not yet the price. Okay, now what do you do with this total return? Do you just leave it like this? I mean, I've said this whole thing is joint probability. So what if it's joint probability? I mean, you found out some number, you've got some return. What is it so far? So then what? Then what? What you do is, now you multiply this return with this joint probability. So I'm going to highlight this. You're going to do this with this. And do like that for every single item. You will get the expected price return in absolute value. Basically, you will get expected return, price plus dividend, absolute return, absolute value return, okay, or absolute value gain, or you can call anything like that, right? So basically you are multiplying 10 into 0.04, 10 into 0.04 is equal to m plus, 40 into 0.1 is equal to m plus, basically I have done this into this, then 70 into 0.06 is equal to m plus, then 15 into 0.06 is equal to m plus, 45 into 0.15 is equal to m plus, 75 into 0.09 is equal to m plus, 20 into 0.1 is equal to m plus, 50 into 0.25 is equal to m plus, 80 into 0.15 is equal to m plus. Memory recall. So basically if you do that, you get 49.5. Now 49.5 is what? It is the expected absolute value in terms of return of comprising both of dividend as well as the price return. Now this is the return. What is it in percentage? Expected return percentage is equal to 49.5 divided by original price, which is 220, or opening price 220, divided by 220. You get 22.5%. Okay, this is the first part. Same way you have to do for y also. So this looks slightly irritating, right? Anyway, let's see. Dividend probability, dividend value, closing price probability, closing price value, then joint probability, then price return, total return, total return into probability. Okay, here I didn't do the total return into probability, I did it on directly on calculator. Here I am doing it separately, that's all. Now what is the dividend probability for this is y, for y things are different, numbers are different. 0.2, 0.2, 0.2, 0.3, 0.3, 0.3, 0.5, 0.5, 0.5, and dividend value is 15%, 15% of 10 rupees. So 1.5. Then next one is 20%, which is 20, 20, 2, 2, 2. Again, I should not make the same mistake. Then 35% of 10 rupees, 3.5, 3.5, 3.5. Then price. Again, probability here is 0.2, 0.5, 0.3, and closing price value is 290, 310, 330. Both are different. Okay, you should not get confused. 0.2, 0.5, 0.3, 0.2, 0.5, 0.3, 290, 310, 330, 290, 310, 330. What is giant probability? Multiplication of these two, which is 0.04, 0.10, 0.06, 0.06, 0.15, 0.09, 0.10, 0.25, 0.15. Now what is the price return? Closing price previously was what? 290 if I am not wrong. Yes, 290 was the closing market price. 290 was the closing market price. So from that 290 for Y Limited, what is the return if the current closing price were to be something else? And we have the numbers here. So what is the price return? See, the previous closing price was 290, correct? From 290 to 290, the return is 0. Correct? So here the price return in the first case will be 0. But in the second case, it has gone up to 310. So what is the price return? Price return will be 310 minus 290, which is 20. Third case, 330 minus 290, which is 40. Right? So 0, 20, 40, 0, 20, 40. This is price return. Now what is total return? You add this 0 to this 1.5. So you get 1.5, 21.5, 41.5. Then next case it is 2. So 2, 22, 42. Next case is 3.5. 3.5, 23.5 and 43.5. Now what is total return into probability? Basically you are multiplying this column with this column. So what will you get? You get 1.5 into 0.04 is equal to m plus, which is 0.06. 21.5 into 0.1 is equal to m plus, which is 2.15. 41.5 into 0.06 equal to m plus 2.49. 2 into 0.06 is equal to m plus 0.12. 22 into 0.15 is equal to m plus 3.3. 42 into 0.09 is equal to m plus. 42 into 0.09 is equal to m plus 3.78. 3.5 into 0.1 is equal to m plus 0.35. 23.5 into 0.25 is equal to m plus 5.875. 43.5 into 0.15 is equal to m plus 6.525. Memory recall, you get 24.65. 24.65. Now see, it's a nuisance computation. Okay. So return percentage is equal to 24.65 divided by opening value, which was what? 290. So divide by 290 is 8.5%. Now this is 8.5 and this is 22.5. What is the weighted average return? Can we use the same 2 crores and 1.5 crore, whatever weight we took earlier? No. Your weights will change. Why will weights change? 20, what is this? 22.5, right? Weighted average return. See, for this year, the return, weighted average return will be computed on opening price. Okay, is equal to 24.65, is what? 22.5 is equal to 22.5 into and 8.5 into weight. How will I compute the weight? This one is 290, okay, opening price, and it is always computed on opening. So portfolio value X, Y, shares, opening price A, B, A into B, okay, total percentage. So shares A, how many? We had 1 lakh shares, and Y we had 50,000 shares. Opening price was 220 or 230, no? 220 and this was 290, correct? No? Let me just check. Yeah, 220 and 230. Okay, this is A into B. If you do 2.2 CR and this is 5 into 290, 290 into 5, you get 1.45 CR. Okay, so total is 3.65 CR. So if you look at percentage, right, 2.2 divided by 3.65, 2.2 divided by 3.65, you will get 60.27% and 39.73%. 3.65 is total. So 2.2 by 3.65, that's what we are doing. So here you will multiply with 60.27 and here you will multiply with 39.73. So 22.5 into 60.27%, you will get 13.56. I'll do M plus 8.5 into 39.73%, I'll get 3.37. I'll again do M plus, I'll do memory recall, you will get 16.9378. Okay, 16.9378. Now this is a slightly longer working. Now let us come back to this. What is the third part of the question? Advise Mr. A on the comparative risk in the two investments. Now what is more risky, boss? Have we computed standard deviation? No. Have we computed the return? Yes. How will you compute risk? By just looking at the return. You have to compute standard deviation. Will you compute standard deviation here? How will you compute standard deviation? You will take mean is very clear. What is mean return? Mean return is 22.5. That is clear. But what is the standard deviation for this year? If you remember the formula for standard deviation, what is standard deviation formula? Standard deviation formula is this, right? Sigma pi into x minus x bar whole square. Now, in this particular point, what is pi? Pi, you will take joint probability. It is very clear. But what is x? What is x bar? Will you take this number, this 22.5 as x bar or average return? You can potentially do that. But if you take this 22.5 at all these points, no, you should compute the return also in percentage. Here we have computed the return only in absolute values. We have not computed in percentage. Same way here also we have computed the return in absolute values, not in percentage. If you do this in percentage, if x is in percentage, x bar also can be in percentage. That is, x is percentage return, x bar is also percentage return. If x bar is percentage return, x cannot, x is not percentage return, you will not get the answer. So both of them have to be in same unit of measurement. So what will you take as x and x bar? When I say x and x bar, whether it is investment x or investment y, think of x as a variable. Okay, I am not referring to, okay, think of this as p minus p bar or q minus q bar or whatever it is, right? So here you should not consider this 8.5 as the mean return. You should consider 24.65 as the mean return. You should consider 24.65. Why are you considering 24.65? Because that is the sum of probability weighted returns, sum of probability weighted absolute returns. So you compute everything with respect to that. So let us see how we do this. Again, this is why this problem has become extremely lengthy and painful and nuisance. Okay, so x limited, joint probability. What are the numbers? I have to go back and see. 0.04, 0.1, 0.06, 0.04, 0.04, 0.1, 0.06, then 0.06, 15, 9, 1, 25, 15, 0.06, 0.15, 0.09, 0.1, 0.25, then 0.15 I think. The values are 10, 40, 70, 15, 45, 75, 10, 40, 20, 50, 80 and 49.5, no? No, for 20 and 49.5, 20, 50, 80. This is a return. Then return minus R mean. Okay, so 10 minus 49.5, that is you will get minus 39.5, minus 9.5, then 20.5, then minus 34.5 and minus 4.5, then 25.5, minus 29.5, 0.5, 30.5. Okay, now R minus R bar whole square into joint probability. That is what you have to do. So I will not do this manually, I will do this on calculator. Okay, so 39.5 into is equal to into 0.04 is equal to m plus, which is 62.41. 9.5 into is equal to into 0.1 is equal to m plus 9.025, 9.025, then 20.5 into is equal to into 0.06 is equal to 25.215, then 34.5 into is equal to into 0.06 is equal to 71.415, 4.5 into is equal to into 0.15 is equal to m plus 3.0375, 25.5 into is equal to into 0.09 is equal to m plus 58.5225, 29.5 into is equal to into 0.1 is equal to m plus 87.025, 0.5 into is equal to into 0.25 is equal to m plus 0.0625. 30.5 into is equal to into 0.15 is equal to m plus 139.5375. 139.5375. If you do memory recall, you get 456.25. So what is the variance is equal to sigma. See, here also I forgot, SD is square root of this. Don't forget, I made that mistake. Now when I solving it, I realized sigma pi into x minus x bar whole square. Standard is equal to root variance, that is equal to square root of this. You get 21.36. Okay, we did for x. Now we'll do for y. What are the probability return minus mean probability into return minus return mean whole square. Okay, what is the probability? We have to look at y, don't take x. What is joint probability here? 0.04, 1 and 0.06 is y only, right? 0.04, 0.1, 0.06. I think we'll have the same numbers. Yeah, I'll have the same numbers. 0.04, 0.1, 0.06. Yeah. Then 0.15, 0.09. And 0.1, 0.25, 0.15. Then what is the return? What is the mean return? You got some 26 or something, no? In case of y. 24.65. So 24.65. And what are the returns at each point? 1.5, 21.5, 41.5. 2, 22, 42, 3.5, 23.5, 43.5. Okay, 24.65. I'll actually do it together here. 1.5 minus 24.65 is equal to minus 23.5 into 23.5 is equal to 535.925 into 0.04 is equal to m plus, which is 21.4369. Just 21.4369. Then 21.5 minus 24.65 is equal to 3 minus 3, that doesn't matter, into is equal to 9.9 into 0.1 is equal to 0.99 m plus 0.99. This is minus 3.15. Then 41.5 minus 24.65 is equal to 16.85 into is equal to 283 into 0.06 equal to m plus 17.03535. Then 2 minus 24.65 is equal to 22.65 into is equal to 5 and 3 into 0.06 is equal to m plus 30.78135. 30.78135. Then 22 minus 24.65 is equal to minus 2.65 into equal to into 0.15 equals 1.053375 m plus. Then 42 minus 24.65 is equal to 17.35 into equal to into 0.09 is equal to m plus 27.0920. 27.0920. Then 3.5 minus 24.65 is equal to minus 21.15 into 0.1 is equal to m plus 44.73225, then 23.5 minus 24.65 is equal to minus 1.15 into equal to into 0.25 equals to m plus 0.330625. 43.5 minus 24.65 is equal to 18.85 into equals to 355 into 0.15 is equal to m plus 53.298375. Okay, then if I do memory recall, I get 196.7525. Now this is what? This is variance. Variance is equal to 196.7525. Standard deviation is equal to square root variance, that is equal to, if I do square root of this, I'll get 14.026. Now you see, what have they asked? Comparative return or comparative risk. What is the exact word? Are we supposed to advise Mr. Ray on comparative risk in two investments? See, if you look at straight standard deviation, no, X, Y, 201516, return, standard deviation, Y is 14.026 and X is 21.36. Should not directly compare. Then return is, average return is what? 8.5 and 22.5. 22.5%, 8.5%. X has higher return and risk on relative basis. Fair enough. So we have finished this problem, which is a variation of the previous problem in which, you know, they've brought in joint probability. It's a nuisance, long, painful. I don't expect them to ask such kind of lengthy questions in exam, because when we are doing this in non-exam environment itself, it has taken us quite a bit of time and a lot of computation. Exam environment, it will take away too much time for 7 marks, 10 marks, for whatever, 4 marks, 6 marks, 7 marks, 8 marks. I am sure they will not ask this question. Okay, they may ask with 2 kinds of probabilities instead of 3, whereas 2 into 2 where there is 4 numbers. Okay, instead of having 9 numbers. Okay, let us move to the next problem then. So friends, now let us look at this next question. This is a question from September 25 RTP. I wanted to add this because it's a good quality question that they have given in the RTP, and you should definitely solve this. Okay. On 1st February 2025, XYZ Limited, a laptop manufacturer, imported a particular type of memory chips from SKH Semiconductor of South Korea. So it appears they are Indian, they have imported from South Korea. Import, matlab they have to make payment. The payment is due in 1 month from the date of the invoice. Okay. Amount of 1190 million South Korean won. Okay, the amount payable is 1190 South Korean won. And when you make payment in the currency in which they have exported. You don't make payment in rupees. You are going to make payment in won, Korean won. Following spot exchange rates on 1st February. So you imported on 1st, these are the 1st February rates. They're going to make repayment after 1 month, which is probably on 28th or 1st of March or whatever it is. Right, are quoted in 2 different markets. USD INR, they've given 85, 85.5 in Mumbai, and USD SKW given 1390 and 1390.9 in New York. Okay. Since hedging of forex risk was part of the company's strategic policy and no contract for hedging of SKW was available at any inshore, it's not inshore or onshore, any onshore market, it approached an offshore non-deliverable forward market for hedging the same risk. So in India, we did not have a INR SKW. So what we did, in India we hedged the dollar leg, and outside India they hedged the dollar versus Korean won leg. Now this is what NDF I explained in the class also. Okay. Then in NDF market, a dealer quoted 1 month USD SKW at 1390 by 1390.60. See, this is spot market, this is different, and in 1 month forward is different. Okay, 1 month forward is very close to spot. Okay, to be settled at reference rate declared by the Bank of Korea after 1 month, that is 1st March. That is what I was telling it, maybe 28th or 1st. The dealer agreed for SKW 1385 as the rate for settlement, and on the same day the spot rates in the above markets were as follows. So settlement rate is this, agreed rate is this, spot rate is this. All rates are different. Okay. Analyze the position of the company under each of the following scenarios compared with spot position on 1st February. Do nothing. If I did not do anything, what will happen? Opting for NDF contract, that is both the rupee SKW and final payment to be computed in rupees lakhs to be rounded off to up to 4 decimals. Please remember, they have specifically said round off to 4 decimals. So let us go and solve this problem. We'll solve it bit by bit. Don't need to hurry and get it. I'll solve it slowly. I'm not going to solve it like exam environment, in which case I'll be rushing forward. I'll solve it slowly so that you understand, because this is a slightly tricky problem. We have not looked at such kind of problems earlier. Okay, first thing. First is what? Do nothing, right? That is no hedge. Basically no hedge. If you don't take any hedge, import value is 1190 million SKW, correct? That's what they said, right? 1190 SKW, okay. USD INR, this is what? This direct quote was how much? 85 by 85.5. Then USD SKW, this was what? 1390 by 90.9. So you have a liability of this much, correct? As on this day, as on this is 1st Feb. On 1st Feb, what is the value of liability in rupee terms? Liability in INR terms. That is, you have to get 1190 SKW, million SKW, is equal to how many INR? Basically, you have to convert this. This is the idea. Now, USD INR rate is given, USD SKW rate is given. So you have to basically arrive at an exchange rate which is between INR and SKW. The reason why I am writing this, you will get to know in a minute. See, USD INR is a direct quote, where USD is the base currency. This is also a direct quote, which is where USD is the base currency. Whereas, what do we want? Do we want how many SKW per INR or how many INR per SKW? We want to make SKW the base currency. So, we need SKW. Per SKW, how many INR will be required? Because we have 1190 million SKW. So, SKW by INR, that is INR by USD is equal to 85.50. SKW by USD is equal to, I'm just writing these numbers, I'm not writing, or I can write this 85 by 85 point this, 1390 by 1390.90. What do we want? We have INR. We have to make Korean won payment. So we will first buy dollars. When you are buying dollars, what rate will be used? You will basically be using this rate. Correct? If you have to buy dollars, banker wish to buy the base currency. Base currency, banker is selling. So why? Because you have to buy dollars. So 85.5 is the relevant rate. Same way in the other case, once you have the dollar, you have to do what? You have to buy dollar, you sell dollar. You have to sell dollar. If you have to sell dollar, banker has to buy. When banker is buying dollars against Korean won, the bid rate will be applicable. So 1390 will be applicable. Okay. So these are the two rates. Now we have to figure out what is to be numerator, what is to be denominator. So we need number of INR per SKW, which is INR by USD into USD by SKW, correct? This is INR per USD is 85.5 into USD per SKW is, SKW per USD is this, what? 1390 by 1390.90. But here we need USD by SKW, which is what? Which is 1 by this number. But what are we looking at? We are looking at bid or ask, we are looking at bid. So 1 by 1390. So you will get a rate of 85.5 divided by 1390. You will get a rate of INR per SKD is equal to 0.0615. Okay, they said fourth decimal everything. Okay, INR per SKD. This is also known as base currency is what? Per SKD. So base currency is SKD INR. Okay, this is market convention. I have been telling this right from beginning. This is market convention. This is understanding. Okay. Okay. Now is 0.0615. Now with this, what are we supposed to do? Per SKD this much. So amount payable in INR on 1 Feb is equal to per SKW you require this many INR. For 1190 SKW, how many INR you require? Simply multiply, is equal to 1190 million SKW into 0.0615 INR per SKW. When you say per, it is divided by, right? So you will get 1190, million is 6 zeros, into 0.0615. You will get how many? 7.73. 73 million, that is 7 crores 31 lakh 85,000 rupees. This is the amount payable. 7 crore 31 lakh 85,000. That is, they have asked in lakhs. That is rupees 731.85 lakhs. Now, have we finished the first part? No, we have not even finished the first part. What was the first part? Analyze the position of the company and reach the following when you don't do anything. When you don't do anything, your outflow originally was 731, but on the due date, on the closing date, which is 1st March, these are the rates payable. So, and with these rates, what is the exchange rate? And please note, here we have taken 85.5 and 1390. Same will apply even for the next time, no? You have computed the liability. Now, when you are making remittance against the liability, you will have your INR and buy USD, then you will sell your USD and buy SKW. So, these two rates will be applicable. So, exchange rate. Here we need not again do this whole Mahabharata Ramayana. Exchange rate INR per SKW on 1st March is equal to, what is the numbers? 85.75. It's called 85.75 divided by 1388, right? 85.75 by 1388. This is INR, this is SKW. That will be 85.75 divided by 1388. That will be 0.06177. So I will take as 0618. Now, so actual payment is equal to, this is this many INR per SKW. Okay, actual payment is 1190 million SKW into 0.0618 INR per SKW. SKW cancel, you will get value in INR. 0.0618 into 1190 million, that is 6 zeros, that is 735.42 lakhs in rupee terms. So, what was the original liability? Original liability was 731, whereas you ended up paying what? 735. So, if you don't do anything, if no hedge is entered into, then excess payment of 735.42 minus, what was that? 731.85. Let's go to rupees 3.57 lakhs will be made. Okay, this is the first part. What is the second part? Part 2. Instead of doing this, if you were to enter into a non-deliverable forward, what is this non-deliverable forward story? You are entering into a non-deliverable, again, same bid ask, all of those will apply same way only, at 1390 by 1390.60. So, that is, you are agreeing to buy, here what did we say, 1390, no? So, same number you are agreeing to buy, but, what did I say? 1390 by 1390.90, 1390 by 1390.60, okay. But why did I say same number? Because for us, what we used 85.5 and 1390. So here also the same 1390 is what will be relevant. The 1390.60 is irrelevant. Whereas on the due date, this 1385 is the settlement number. So even though I agreed at this is the settlement number. So you see, after 1 month, What is the specific date? It approached an offshore non-deliverable market for hedging the same. In the NDF market, a dealer quoted 1 month rate, settled at reference rate declared so and so. After 1 month, the dealer agreed for SKW as a rate for settlement on the same date. So initially, when you had dollars, right? First you sold rupees, got dollars. That dollars you agreed and you got some won. Okay, you got some won. How much? 13901 per dollar. Correct? That is what this means, right? You sold a dollar, got some won. But now settlement is at 1385. That means you will sell off the won again. See, in India, what happens? Actual delivery does not take place. You just settle and get a net cash settlement. Now, when you settle, you are for $1 you need to give only 1385 won. So initially, when you gave a dollar, you got 13901. Whereas when you are settling, you are giving 1385 won to get $1. So there is a profit. How does that profit work? Let us see. So 1st February, NDF. In NDF, you say you have dollars. So buy SKW at 1390 SKW per dollar for how much value? For 1190 million SKW. That is, you require 1190 million SKW. So how many dollars will you give? That is, dollar outflow is equal to 1190 million divided by 1390. That is 1190 million divided by 1390. That is USD 856,115.1079. They said 4 decimals, I am using 4 decimals. But eventually the Korean won rate has changed. So what will you do? You will reverse the transaction. When you reverse the transaction, here what you do? You sold dollars, right? So you will buy back the dollars and sell off the Korean won. That's why, because in NDF, settlement happens only in dollars. It doesn't happen in Korean won. So in what happens in NDF? Originally, you bought so many SKW by selling dollars. So dollars is an outflow, gone. Eventually, when the settlement rate is announced, there was a dollar outflow, you will have a dollar inflow, and the net gain or loss is in dollar terms. When there is going to be a dollar inflow, you will basically sell off Korean won. Initially, you bought Korean won. Now you will sell Korean won. When you sell Korean won, sell SKW, okay, for 1190 million. You sell SKW for 1190 million, and if there is any profit, that is left it in dollars. So 1190 million at 1385 SKW per USD. Correct? That is the number they are given, right? 1385. So what will happen? How many US dollars will you get? You will get 1190 divided by 1385. You will get by 859 or inflow, I will say inflow, USD 859,205.7762. Okay, this is outflow minus this is inflow plus. So USD inflow is equal to net USD inflow is equal to this minus 856,115.1079. That will give you 3090.6683. So net USD inflow. So you've got this many USD extra. You've got this many USD extra. See, on the eventual date, what remittance are you making? You are making a remittance of 735. Why? Because if you have hedged it in the NDF market, there is no forward contract, nothing. So what will you do? You will basically make spot payment only. That is, you will make the spot payment of 735.42. Your original liability was recorded at what? 731.85. Now what we have to evaluate is, if you do this NDF, you have also got a gain. So your net remittance is what? Gain of USD 3090.6683 in INR terms. So if you have 3090 US dollars, what will you do in the market? You have profit in dollar terms. You will sell dollars. If you are selling dollars, banker is buying dollars. Banker is buying dollars means he is buying the base currency. Base currency buy means bid. So what is the bid rate on last date? 85.5. So he will buy from you at 85.5. So you will get that many rupees. you'll get that many rupees. So is equal to 3090.6683 USD into 85.5 INR per USD. So USD cancel, you will get into 85.5, you will get 2,64,252.1373 rupees. You convert this into lakhs, you get rupees 2.6425 lakhs. You got 2.6425 lakhs. This is the gain. So what is net outflow? Is equal to 735. We had some number. What is that? 735.42 minus 2.6425. That is equal to 732.7775 lakhs. 732.7775 lakhs. Now, this 732.7775 lakhs, how does it compare? This is your outflow. Compared to previous one, what was that? 731, no? 731.85. Liability was recognized at 731.55. So, original liability at 731.85 lakhs. So, net loss is equal to difference between these two, minus 731.85, 0.9275 lakhs. Okay, net loss is this. Now, if you look at the RTP answer, it is slightly different because I have taken 4 decimals here and they have taken rounded off to this one, 3091. They have rounded off to 3091, but the question doesn't say you can round off this decimal. Everywhere they said to be rounded off 4 decimals. So that is why I took 4 decimals. Anyway, they have rounded off to this number as 3091, which is not correct. Net losses is rupees 0.9275 lakhs. So, which is better? NDF option is better. NDF option is better as it results in lower loss. Now, in this entire question, right, what is the key issue or what is the main thing? It is not even about that what is to buy, what is to sell, all of that. All of those you'll figure out. But the key issue is how does settlement for NDF happen? That is the key issue. See, forget this particular question, okay. If you enter into a NDF contract, NDF is non-deliverable. So, you are agreeing to buy something at, let's say, 100 rupees. Okay. Now, on the due date, if that, if the market is not 100 for that, let it say is 110. What will happen? On the due date, if the market is 110, you are doing net cash settlement. How much will you get? You have agreed to buy at 100, market is 110, so you will get the 10 rupees back. Right? They will give you 10 rupees back. In this question, you flip the same argument, which is if I sell $1, I will get an inflow of 1390. That is what was the rate, right? 1390 was the SKW rate. So $1 is getting me 1390 SKW. On a later date, right? When I am unwinding this contract, $1 is getting me only 1385. That is, initially itself I was smart to get 5 SKW more. Right? So if I give you $1, I'm going to get 1390 SKW. But later date, the rate has fallen. Okay. Now, if it were ulta, it would be a loss. Correct? If let's say I'm getting 1390 SKW, in the settlement rate it was 1400, then it's a loss. Why? I am agreeing for $1 if I give, I'll get 1390, but like stupid I enter into this contract, whereas reality mein $1 I'll get 1400 SKW. Right? So I will have a 10 SKW loss. Now that loss, you don't look at it in SKW terms. Why? The contract is entered in dollar terms. So everything you convert it into dollar terms. Whatever dollars I have sold, basically I have SKW. I will give off the SKW and get more. And when I'm giving SKW, I don't have to give 1390 SKW for giving $1. I need to give only 1385 SKW. So I'm basically giving fewer SKW to get $1. So when I'm getting $1, whatever SKW I have, I'll actually get more dollars. So I'm basically buying back the dollars. That is, there is a dollar inflow. outflow. Initially there was a dollar outflow, now there is a dollar inflow. So net I actually have more dollars. This is how net cash settlement happens in case of an NDF. That is the key thing in case of this particular question. We have seen other questions also where, in case of futures contract, there is a net cash settlement. So the futures contract, you agreed to buy at a certain price, but settlement is happening at a different price. The difference between those two is your gain or profit, and you add that to the spot contract to arrive at eventual effective price for you. We have solved a couple of problems. I 100% remember, I think in some commodity problems we have solved. Okay, fair enough. This basically is a question which I wanted to necessarily solve. Okay, fair enough. Now let us move to the next question.